What is going on, everybody? Welcome back to yet another brand new YouTube video. Now in today's YouTube video, we'll be going through this trade that I took on the 4th of February, and I will be showing you guys how to execute this trade, where to put your stop loss, take profits, so on and so forth. So without further ado, let's get right into the video. So before I even look for a trade, I always want to be marking out all my previous liquidity session highs and lows, such as the Asia highs and the London highs, as well as the previous day lows and the previous day highs. And the reason being is because I want to see when we hop into the New York AM session whether we're going to actually sweep one of these liquidity levels or not. Now, I don't take a trade unless we sweep one of these liquidity levels, the previous session liquidity levels. I always have to wait for one of these liquidity levels to get swept. And the reason being is because price just moves from buy side liquidity to sell side liquidity, and from sell side liquidity to buy side liquidity. That's just simply how price moves. So if we look very closely right here, we see that we split up our pretty much chart into sections. So we got the Asia session right here from 18 o'clock all the way to 2, and then from 2 to 8:30 is the London session. Now, if we mark up all the highs and lows of each session, we come up with the London lows that are still intact, and also we have previous day low on NQ still intact. And if we look onto the right hand side, which is on S&P 500, we also want to mark up all the previous session highs and lows, and we do have the London lows right here still intact, and also the previous day low. So from that, we want to now, we'll go into the 1 minute time frame and see which buy side or sell side liquidity level is going to get swept, and from then we could start looking for our trade. So coming into the 1 minute time frame, we see that 8:30 pre-market opens. This is all in New York time, so make sure to guys switch your clocks on TradingView to New York time so you don't get confused between your local time and the New York time if you live outside of the New York time zone. So as soon as pre-market opens at 8:30, we get a sweep of London lows, but we do not trade before 9:45 because that is our macro time start. Our macro time is always from 9:45 to 10:15, and the second AM macro is from 10:45 all the way to 11:15. Now keep in mind, you only want to trade and take your trades and execute only within those two 30-minute intervals, because that is the times where price makes those runs and actually seek key levels in price. Now if we keep on looking on NQ, we see, if we zoom out, that we get a sweep of a previous day low, which is a key level, and we also do get another sell side liquidity level. Again, that's just a bonus. We do get this sell side liquidity level swept at 10 o'clock. So the previous day low level is enough for us to take a trade. We don't have to see another sell side liquidity level getting swept, but in this scenario, we just simply did. Now, again, if we look to the S&P 500, we also get the London lows level getting swept, but we don't have to monitor both liquidity levels. If NQ swept a sell side liquidity level, we don't have to wait for ES to sweep a liquidity level in order for us to take a trade. One is enough. All right, so we always have a trade criteria that we always have to follow, and the first step in this trade criteria is we must get a sweep of either a sell side or buy side liquidity. And obviously in this example, we got a sweep of sell side liquidity, which was the previous day low level. Now the second step on our trade criteria is going to be a swing high to be formed. I want to see a swing high being created after sweeping that sell side liquidity level. And the reason being is because step number 3 and step number 4 are both correlated and are related to that step number 3. And we actually can't move on to step number 3 or 4 if we don't have to step number 2. So if we look very closely right here, we do have that 10:05 swing high getting created. And if we also look on S&P 500, we also do get this swing high created at, again, 10:05. Now, you might be asking, why would you be marking up the ES&P asset when you're going to be trading NQ? And the reason being is because I always want to see correlating assets. That means I want to see the same price action that's happening on NQ happening on S&P 500. Now, if I do not get a swing high on S&P, but I do get it on NQ, I can't move on with the trade. I have to see both assets giving me the same price action. This makes the trade more of a higher probability of trade that it will go into our favor. Now, coming into step number 3 and step number 4, which is market structure shift and a displacement. Now, a market structure shift is simply this candle right here at 10:07. It opens, breaks this swing high, and closes above that swing high. And a displacement is a massive impulsive move to the upside. As we could see, this candle does so. Now, again, I want to see the same thing happening on NQ happen on ES. And again, we get this massive displacement and market structure shift to the upside on ES&P. So far, so good. as both assets are correlating and we are getting the trade criteria form right in front of us. Coming into step number 5 on our checklist criteria would be the fair value gap. I want to see a fair value gap form because that is going to be our entry point as soon as price retraces into that fair value. So the fair value gap we do get with this massive displacement and market structure shift right here at 10.07, and we also get the same fair value gap that is formed on ES&P at 10.07 as well. Now, one thing that I have to tell you guys is that we don't have to see a fair value gap on ES&P 500. The only 3 steps that we must see on both assets to have a high probability of a trade is step number 2, 3, and 4. The swing high, the market structure shift, and the displacement. All of these must be present in both assets in order to have a high probability of a trade. Now, coming into step number 6 is going to be our entry into the trade, which is going to be determined by a retracement into that fair value gap. And what I mean by that is, as soon as price comes and taps into this fair value gap, as we could see, it does so at 10.14, which is literally a minute before the macro closes. Now, if the macro time closed and we were outside of that time window, we would have not taken the trade, as we only take and execute within those 30-minute intervals. So if price retraced into that fair value gap at 10.15 or 10.16, would have simply not taken the trade, as we only follow our rules and our rules only. We must always follow our rules no matter what, no matter how good the trade looks. If we're outside the macro, then we do not take the trade. Simple as that. Now, for our stop loss, we want to be placing our stop loss in the scenario below the displacement candle's low. Now, for our target, we're going to be targeting the lowest hanging fruit. And as I always mentioned, we want to always be targeting our lowest hanging fruit, which is going to be this swing high right here. Now, you could also be targeting this swing high and this swing high right there as well, these minor buy side liquidity levels, but they are not low hanging fruit. This is low hanging fruit. The nearest swing high to the left of us is going to be a lowest hanging fruit. Okay, that gives us obviously a reasonable risk to reward. We don't want to be having a negative risk to reward, such as something like this, right? We're going to want to be risking 42 to make 17 handles. We want to be risking a good amount of handles to make a double the amount of handles that we're risking. So this right here would be a great target to be targeting. Now, if you look very closely, we do not actually take out this target on NQ, but however, if you look on ES&P 500, the exact same swing high we do take out. Now, this is very crucial. Whenever we take out the objective on ES&P 500, we must fully close out the position on NQ. Now, you can leave a runner or two, and here's an example right in front of you. If you would wait for that swing high to get hit on NQ, when it already did hit on ES&P, you would have never made even profits, and you would have probably got stopped out at break even. And there you guys have it, the ICT silver bullet model. If you guys do have any questions, let me know in the comments down below, and I'll be sure to get to them within the next 24 hours or less. Now, before you guys do go anywhere, we are on our way to 1,000 subscribers. So if you guys do want to help the channel and support the channel, subscribe down below. Now, I do have a VIP top trading floor Discord server where you guys could come in and literally take trades like this with me on a regular basis, bagging around 100 handles on the day. There's also heaps of support, a whole blueprint channel for my strategy, and a whole trader chat to chat with like-minded traders like yourself. So if you guys are willing and are interested in joining the VIP top trading floor Discord server, the link will be in the description down below for that. Now, thank you guys for watching, and until the next time, peace.